let's understand what all different time frames that are available for you and how can you use these time frames to basically trade in a different psyche or a different psychological mindset. So now that you understand the different trading methods that are available for you as a trader, let's understand what all different time frames that are available for you and how can you use these time frames to basically trade in a different psyche or a different psychological mindset. If you've already heard about intraday traders or positional traders or even swing traders, they're basically just using a different duration in the time frame to execute their trade. So they enter and exit the market in different durations with different logics behind what they perceive to be the best situation to get into the trade and how fast they want to come out of that trade as well. If you're a swing trader, you might wait for a much longer duration, whereas to a intraday trader or even a scalper. So let's understand more about these and see what all various types of trading time frames that are available to crypto traders as well. The first and the shortest duration of trade is usually for scalping. Trade to make money or profit out of very small movements in price, say for a few seconds or even a couple of minutes. The time frame here is really short and won't last for more than a couple of minutes. And here, the risk of losing a lot of money on a single trade is also quite huge if you have garnered like small trade wins and you're here with a big position size and now you're in a higher risk position because it's a scalp trading and you only have a few minutes that you need to close the trade at. So risk management and the ability to cut losses here is very, very important as the profit margins are really, really small. It's very important to protect the profits that you've already made rather than going in for calls that can be highly risky and end up making you lose the trade. The second one is intraday trading, and it's all about trying to capture more than normal or above average return for a cryptocurrency that usually does not give many returns. For example, a cryptocurrency moves by 2 to 3% in a day. And if you can trade intraday, the same cryptocurrency for 5 to 6%, that's a great trade because you've made more money and can capture more movement in the price than what usually the price for that particular day is. So this is based more upon day's characteristics than the cryptocurrency itself. Sometimes the markets are volatile because of some news or other factors that we discussed earlier. And that is when intraday traders get a bigger move than usual. This can last from a few minutes to even under a day. So anything which lasts for a day or less is kind of called intraday trading. So you take up a position starting of the day, and by the end of the day, you have either closed your position or if the situation arises that you really want to continue that trade and the targets have not been met and you're really eyeing some key targets, usually intraday traders come out of the market, they close their positions, but we'll talk about this in later advanced courses of what you can do when positions are not met, and your analysis or your even your gut says to go for it, and what do you do in those situations. So we'll talk about that in the advanced courses, but for now, intraday trading is when you start up a position. You can even last for a few minutes. That's also if you start a position, you open a position and you end a position, or you close a position in the same day, is what intraday trading is all about. It's a very time-consuming, effort-driving, affair. But if you know what you're doing and you got your technicals right and you're really understanding how the market moves and you're trying to understand the direction and you're dedicated to the charts and to yourself in terms of emotions and everything, then it's a really, really great career as well to have, being an intraday trader. Although next we will talk about swing trades or swing trading that tries to capture a larger swing of the market rather than just intraday movements as such. The idea is here to capture a larger move in the time frame, and the time frames can be from up to a day to even a week, or so. So basically, a couple of days or a week is just normal in a swing trader's life to take positions for a couple of weeks. The trend is already the swing trader has already identified a trend. They're trying to follow the trend, and as you can the trend is your friend. And the last lot that we want to talk about is for positional traders. This is more about thesis-driven approach. You're taking positions for a very long term, or even like longer term than what we just spoke about in terms of trading. So when you understand certain characteristics about the market that are favorable situations for you and can affect the cryptocurrency that you are trying to take a position in, and you believe that this cryptocurrency will be an uptrend or a downtrend depending on the side of trade direction, and you really want to make money out of this larger move, then this is what you do. You become a positional trader. You take a position for a larger move. You know that the characteristics right now attribute that X cryptocurrency is going to outperform Y cryptocurrency, and due to this, maybe Y, the price of Y goes down and you want to short Y. That's when you want to convince yourself to be a positional trader and take a longer swing into the market. So here, like I said, the trade can last from a few weeks to even several months, and it is made only because of a larger term movement and not because small intraday movements that some news came in and you're trying to, if that news was completely life changing for that cryptocurrency, then yes, why not? But small news or even like trying to not get into FUDs and then do a sell off and then try to buy back again, all that is not positional trading. Positional trading is for larger movements. You know that something big has happened. It will affect it. The characteristics support, the whole fundamentals support that there would be an uptrend or a downtrend guaranteed, and that's why you are taking that position into the market. So now let us go back to the screen to check out the different time frames and how they look on the chart, and what are the time frames that you should be using in your charts to become one of these traders. So let's dive in and see what all time frames that exist for us to trade. And I'm already on my CoinDCX account. I've already logged in. If you haven't logged in and you are facing difficulties in creating your account, then we have already made videos for helping you to sign up and helping you to conduct your KYC, connecting your bank accounts, and you can follow all those videos and then come back here and we'll look into timeframes. So great. I think you have set up your account, and now let's go in and see what all time frames exist. So right now we'll go into trade and we'll just open the spot market on CoinDCX, and you can see, so let's just Ethereum's market is here. So let's just pick up Bitcoin's market. It's already in my favorited section, and you can see, so the chart is loading. Let's give it some time. Let's wait for it to load. As the trading view chart is loading inside of CoinDCX, let me just try to refresh the screen, quick time. And here we go. So yeah, you can see the chart here. And as you can see, this is a Bitcoin to INR chart. And on the left side, you can see that right now, this chart is selected for a daily time frame. So it says D. And when you hover upon it, it says 1 day. But when you want to select a different time frame, depending upon what kind of trades that you want to take, if you were talking about a scalping, then you're talking about very, very small time frames, especially like minute time frames. And now when you see the chart looks very different to what it would look in a daily time frame to a minute based time frame. And if you're trying to scalp, you're trying to be trying to scalp a position, a very quick position, very quick entry and a very quick exit in a couple of minutes. So let's say, for example, you would take a position if you would take a position right here. If you would take a position right here, then you would want to exit the trade somewhere in the next couple of minutes right here. Going and waiting for a scalp trade for 10 minutes usually won't cut the deal. Moving on, you can see that I have many other time frames opened up to even a month. So it depends on what kind of a trading attribute that you're trying to follow. Usually 5 to 15 minutes is what is followed by intraday traders. And this makes them, like not look at the macro trend in terms of general views, what a positional trader would look in a daily trend, but they're specifically talking about a day. And as you can see, we're on 25th of January, and here you can see that if I started my trade on the 25th of January, I would need to exit my trade by the end of 25th of January. Although cryptocurrency markets are usually 24/7 markets, and intraday was, kind of a concept that evolved from traditional markets, where markets open at a certain point of time, as we discussed earlier, and they close back in the afternoon or evening, whatever the time set is. So they open at a certain point of time and they close at a certain point of time. Rest of the time, so for an intraday trader, you had to close the position. But in terms of Bitcoin or cryptocurrencies, as we know that these are 24-hour markets. So we need to understand that when we are going into that, understanding what time frame that we're choosing as an intraday trader, 5 to 15 minutes, you still are wanting to close the trade in that stipulated 24 hours rather than extending that trade. But if you are doing swing trades, you are easily welcome to use 2 hours to 4 hour charts, which give you a macro hindsight and a macro level view of what's happening through days. And you're trying to define the price direction, you're trying to identify the price direction and the trend of that price movement, and then go with that and swing on that. And usually all that happens when you see your technicals working on a 2 to 4 hour chart. So when I'm talking about time frames, technicals work everywhere. All right. So when we're looking at charts, it doesn't matter if you're looking at a 5-minute chart or a 2-hour chart or a daily chart. So, the data points that you get out of it, or what you can understand, obviously different indicators for different time frames usually exist, but what you're trying to identify here is the indicators are just base work or foundational knowledge of what you can have to kind of bring in a logic or an equation of what you would want your trade to be, why you're saying that it is going in an uptrend. So when you're taking a swing trade, 2 to 4 hour time slots, this is where you're trying to understand that I'm going with this uptrend, I've identified an uptrend, and I've already gotten a confirmation that there is this uptrend or whatever your pattern indicates, and you go in for a longer move. It can last to even a couple of days. Now, for traders that are positional traders, when we talked about these long-term movements that we're trying to grab. So for example, then we will go into much higher time frames like a day, or sometimes even a week, but days are usually what we would prefer in going into long-term positions. So here you can see that there has been a really strong move on the up, and whatever we're seeing right now in terms of consolidation or correction that someone would say, or distribution, depending upon what side of lingo you're coming from, but everyone was there was a sudden price hike, and this was the accumulation phase, and then this going down was a distribution phase. And these days of strong up movements on a daily basis can really help you identify that there is a strong uptrend. And if you were a positional trader, obviously you would have longed it somewhere around the 7 lakh, 8 lakh, 10 lakh levels, where it was in the 7,000 to 12,000 range. A lot of people would have entered the market, and it was high time of consolidation. The market waited a long time here and then quickly made an uptrend where people would have taken a positional trade on a daily chart. So now we have understood charts. Obviously, we learn a lot more about things, but now, as we know the time frames that exist for us, very short time frames exist for traders who want to scalp the market. Quick time, they look at 1-minute charts, 5-minute charts. Even 5-minute charts are like really high in terms of, or I would say longer in terms of scalpers. They'd request it for a minute, 3 minutes, 5 minutes is the max. Then you have intraday traders that could use 5 minutes to 15 minutes time frames. Swing traders can use hourly charts. I would recommend 2 hours to 4 hours for a strong decision. And positional trades, they will use mostly daily charts and weekly charts. So that's much about what time frames are existing for us to trade the markets. And usually in all kinds of traditional markets and in all other traditional markets, these are the time frames that you get as a trader. You need to decide what kind of position that we are taking in. Are we becoming a scalper, or do we have a mindset of an intraday trader? Do we want to close positions on the same day, or have we identified a trend and you want to take that as a swing trade, following a pattern, consistent uptrend or a downtrend that you have identified, and then you want to charge on that position? Or in the end, you want to take a positional trade, which you understand that this has a great fundamental, the characteristics of the cryptocurrency is really, really good, and you want to be a positional trader and hold that currency for a longer term movement. Now, I'm not saying that movement can be up or down, it's long term. So all that we understood. Now in trading time frames, let's move quickly to what kind of trading instruments exist and how we can use them to mark our own trades.